All right. Good morning, everyone. Pleasure to kick things off today for Innovate Miami here with the Thai. So thank you very much for organizing and hosting us this morning. First panel of the day is around stablecoins. I guess probably one of the most transformative and instrumental aspects of the industry over the last 18 months in particular, in terms of how that's penetrated Wall Street with the Circle IPO, many other things happening, and I guess doomsday predictions for the end of the financial industry as we know it from some of our crypto maxis in the industry over the last few years. So really excited to unpack that together with some investors and strategic partners in the industry who have been covering this space over the years and know a thing or two about stablecoins. So just by way of background, my name's Leeor Groen. I'm a partner at Spartan Group. Spartan Group is a investment banking group and advisory and asset management business based out of Asia. We cover Web3 since 2017, founded by three former Goldman partners with the idea of building a platform for the industry to work from first check-in all the way through to exits, leading entrepreneurs in the space. So we've proudly been investors in companies like Circle and others over the years, and glad to dive deeper into this today. I'll hand over to the panelists here. Would love for everyone to be able to introduce themselves so you get some background on who we have here, and we can get stuck into it from there. So please.
Hey everyone, I'm Chris King. I'm an investor at a fund called Fintech Collective. We're a Fintech VC based in New York City, been around since 2013. I've been investing in digital assets since 2017. I think we're one of few funds that has been both a traditional fintech fund and had a more crypto-native crypto fund under the same umbrella. So yeah, I think very much focused on all things stablecoins now and excited to have a conversation.
Rajeev Bamra from Moody's Ratings. We evaluate credit risk for a living and now increasingly looking at digital financial infrastructure, not because the technology is impressive, but to understand the underlying digital asset risk and the novel risks and how they may impact the evolving ecosystem and digital economy. So my role is to make sure that our organization is business ready for the digital economy future and fill the gaps where necessary and where appropriate. Glad to be here.
Good morning, everyone. Thanks for having me. I'm Alavi, managing partner at White Star Capital. We're a global venture fund. We've been around since 2014. We have about 1.5 billion assets under management, both in traditional venture, but also crypto venture, also liquid venture. We're very global in investing across the globe with offices in London, Paris, New York, Austin, and now Miami. I'm recently here in Miami. And we've done historically both investments in enterprise and consumer, a pretty big, heavy focus on fintech. And since 2020, also a big focus and dedicated funds and digital assets in crypto.
Excellent. So, guys, let's jump right into it. And I think stablecoins have been one of the most prolific, use cases that are understood and adopted by the industry today. We've had major breakout successes with things like Tether, Circle, and other issuers of stablecoins. We have a lot of adoption on Wall Street, large financial institutions globally, trialing and testing their own versions of these things. What does this actually mean, stablecoins winning? Like, what does that look like? And how do we start thinking about where we are today in 2026?
Yeah, happy to kick it off. I mean, I think for where we are today, I think it's kind of astounding to see the progress we've made just from a supply side. I think we look at we have a 20-ish company portfolio in Latin America, and I think it's been great to see a lot of our more traditional fintech companies look to integrate stablecoins in some way, shape, or form, because it solves a problem that these companies have faced for decades, where they're able to offer lower FX fees for remittances or able to offer just US dollar exposure to their customers that would otherwise have a very hard time getting exposure to US dollar, would have to pay significant fees to do so. So I think this sort of collapse of local regulatory sort of hurdles in emerging countries has been something that I'm really excited by. And I think over the next 5 to 10 years, we'll start to see a lot of the sort of like traditional guardrails that have been put up by financial institutions and regulatory bodies across the world compress and have just much more fluid financial system.
I can go next. The way I would think about it or explain that is imagine walking past a brand new build, a $1 billion building under construction. What do you see first? It's the cranes on the top and the shiny glass being put up, and the building looks amazing. But what we don't actually see or focus on is how on the ground the trucks are pouring in cement and gravel to make sure that the foundation is strong. Because that's the boring work. It's not as exciting as what you see on the top. And that boring work is what Moody's ratings basically does, right? And that's what we are trying to focus on with our industry-first stablecoin methodology that we launched about a month ago. Because the methodology evaluates the quality of the reserves. It evaluates how the reserves are segregated and the control mechanisms around that. It evaluates the market value risk of those reserves, because it's important to understand how those reserves are being traded on secondary markets, and if that impacts the tokenized version, which is the stablecoin on blockchain rails, and then operational risks and then counterparty risks that comes along with that, because now you have this decentralized custodian potentially holding your token. You have other technologies like the underlying blockchain platform and the interoperability frameworks. So I think for stablecoin to win, it has to become boring. And why I'm saying that is, we today don't think about using a SWIFT or a Visa MasterCard rail or a Fed funds, because they are invisible. They have built the infrastructure over decades, and they are working in the back end at scale, and nobody realizes that that's what they've been doing for a long time. And stablecoin has to become that for it to be called a winner, and that's what it would. That is, in my eyes, is how stablecoins can be given the gold medal.
Yeah, so making it boring, but then boring and functional, I guess, goes hand in hand in this. And you mentioned some good points earlier about the, let's say, Latin American corridor and how that gets adopted for people looking for US dollar exposure in the most affordable way. If we do play that out, though, for example, a lot of the reasons why in some countries specifically there are capital controls which are preventing people from, intentionally by design and structurally, preventing people from actually having access to at least USD products. Is that something that we think we can reasonably work around, or how do you see that playing out with some of the portfolio companies and opportunities that you see in the fintech community in Latin America?
It's a good question. I think we're starting to see the emergence of a lot of like longer tail dollar, like stablecoin assets. I think in Brazil, we're starting to see a lot of traction from companies like Groen that have, or Venya as well, that have like a digital real. Historically, USDT, like US dollar based stablecoins have been 90% plus of stablecoin supply. I think the US, from a regulatory perspective, has been okay with this because they like to maintain this sort of like global dollar hegemony that we have, and they like the fact that reserves are being pushed into money market funds and US-based assets. I think as other regulatory bodies around the world catch up, they're going to start to push a lot of the digital flows that are maybe now happening in US-based stablecoins into their own local currency stablecoins. And so that is something that we're trying to think about from an investment perspective, and where and when those sort of like longer tail issuers are investable, and whether it'll be a new entrant or an incumbent that comes in and issues those.
I'll just add, I think the easy narrative is stablecoin for payments, but I think what's been happening, and the biggest chunk is really what's happening as a stablecoin for a settlement layer, right? If you think about the 35 trillion or plus stablecoin volumes last year and probably more this year, 60% of those have been more into B2B settlement layer, right? So I don't think the question is my Starbucks app going to be run on stablecoin rails initially? That's probably not the use case. The use case is the treasury of Boeing going to settle $400 million for a new aircraft via stablecoin rails, as opposed to using for correspondent banking. And I think we're seeing more and more of those. Again, because of this, the larger, most volume in the space has been B2B, as opposed to retail tapping and buying coffee with stablecoins. I think that's coming later. That will come, and that'll come infiltrate the market. But initially, it's that bigger piece. That's the settlement layer that is important.
And just on that, I mean, like Circle also put out its numbers, not to harp on about Circle disclosing that, but basically the volume's exceeding processing volume of Visa, right? And I think this is a point we touched on. What does that mean in practice then for, I guess, the concepts that we have about money as people follow the liquidity, where the volumes are, what's happening? If stablecoins are really, let's say third-party, non-traditional fintech issued stablecoins are going to be the dominant players going forward, what does that mean then for these the competitive landscape there? And are these players going to actually be replacing the Visa and MasterCards, or is there a scenario where they're hand-in-hand collaborating?
I don't think they're going to be replacing. I think maybe Visa and MasterCard will become rather the credit and trust layer, but they're going to be on top of stablecoins as opposed to stablecoins being run on top of Visa and MasterCard. I think the narrative has been kind of flipped on its head, and it's really about, again, disrupting that 2-3% fee that Visa takes, and that's where things are going. I think the business model for Visa and MasterCard are not dead, but they're going to get compressed and disrupted, and just become completely different.
If I can add, and I probably have a different viewpoint, right? We are looking at potentially the wrong industry participants. I think what are going to be disrupted or disintermediated or at the risk of being disintermediated are the correspondent banks. Mm-hmm. So if you're transferring money from US to, let's say, Hong Kong, there are 5 or 7 correspondent banks in the middle that are actually taking a percentage of what you're transferring to, and that's how they sustain their business models. Visa and MasterCard have already proven they have global settlement rails, and I think the one place I would disagree, and happy to discuss that, is I think stablecoins will operate on top of Visa MasterCard rails, not the other way around. I think the correspondent banks is what nobody's looking at, and that's also where major credit risk globally sits. Yeah. Because if they are disintermediated, that's disintermediating the entire global banking architecture as it is set today, because you're suddenly removing pieces from the existing banking layers without actually having a robust at-scale tested at scale infrastructure like a stable coin, and that's what needs to be paid attention to, is my opinion.
Yeah, no, and look, I think this is a really important topic, because I do want to come back to the bank specifically. It's I guess one of the core focus areas for this. But we touch on an interesting thing of the cross-border payment corridors, and I mean, there's been a lot of innovation in the fintech space over the last decades as well. We've had breakout success of companies like AirwellX, TransferWise, or Wise, one of the leaders in Europe, obviously, and many of these other players. Be curious to get your views there, Chris. I mean, how do you see this distinction between I guess, FX-enabled first fintech businesses and how they touch and interact with, I guess, a lot of the innovation that's happening within the crypto-native, let's say, side of the industry with stablecoin rails? Is there a convergence there? Are they heading in different directions? I feel AirwellX has been very public on their distaste towards stablecoins. Is this all PR, or how do you view that as a more generalist fintech fund?
Yeah, I think from a more, I guess, a broader lens, I think the way we think about it is like distribution ultimately is what matters here. And I think like a lot of these fintechs can settle currencies across stablecoin rails or across more traditional rails. I think that's less important to them. I think when you look 10 years out, like what is from first principles the most efficient way to settle assets, and to be able to do it 24/7 and to be able to do it sort of around the world, like stablecoin rails are much more effective than what exists today. And so I think when you look at I guess to go more on the consumer side, when you look at companies like Dollar App, which is now Arc and is expanding into the US from Latin America and has grown sort of their presence in market share in Latin America extremely quickly. I think they've been able to do that because they've been operating on stablecoin rails from day one, and that's given them a competitive advantage against a lot of other sort of like neobanks and local remittance players that have existed. So I think, yeah, as we grow, I think it ultimately comes down to distribution being key and being able to navigate all these different local regulatory sort of agencies as they change.
Yeah. Yeah, and Sep, I mean, how about on your end? I mean, I always find it good to speak to people who have the Web3 fund as well as a more traditional VC fund. I mean, is this a similar way to how you guys are thinking about this at Whitestar?
Yeah, absolutely. It's very, very much agree with what Chris just said. We're seeing a lot of companies now just building directly on stablecoins. That's like the main stack of what they're doing, bypassing everything else. So I think that world is also converging, and we're seeing that there's a little bit of conflict internally when we're now investing. And that just really started recently, where we look at a deal and it's like, which fund does it go to? Does it go to the crypto fund or the fintech fund? Because it's becoming the same.
Yeah, good. Okay, which is probably a good segue then, if we are aligned on where the industry's going in terms of fintech versus crypto nativeness. Let's talk about the banks, right? I think this is the big needle mover, and countless times and iterations in every cycle where the banks are saying, yes, we're doing this, and JPM internal coin for cross or within the bank, so intra-bank and cross-bank settlements that they're trying to use with their own versions of a stablecoin. How are the banks thinking about this? Rajeev, I'd love to get your view on what you're seeing in terms of your distribution partners and partners to your core business. What are they looking and seeing, and when they hear stablecoin, what are they thinking about?
Maybe the way I'll answer that question is to think about coexistence of multiple currencies. We touched upon it earlier. Some jurisdictions are working on central bank digital currencies, and if they do start issuing that in the next few years, the banks and the institutions in that jurisdiction will be asked to use CBDCs for end of day settlement directly with the central bank. Tokenized deposits and deposit tokens will be also used within institutions, maybe inter institutions, and there are some POCs pilots that are currently running. And stablecoins will be on the top, actually playing the bridge between DeFi, TradFi, and also cross-border. And I think that's how the architecture is being built, and the institutions understand that aspect. And what they are also hedging is against the risks that sit under the stable coins, because the CBDC is a direct liability of the central bank. Tokenized deposit or deposit tokens, direct liability of the commercial bank. But for stablecoin, there is no direct liability yet, and that's exactly where a lot of risks that institutions are trying to understand, that we are building the infrastructure. How do we now start transacting and using these stable coins in our day-to-day business as usual activities? It does offer collateral mobility. It does solve for cross-border settlements in a short period of time. But how safe is it to actually run billions or trillions of dollars worth of traditional economy on those rails? And that's actually the foundational or the fundamental concern that literally investors, issuers, and even regulators have. So it's not questioning the technology. I think everybody has realized, yes,
Accepted, yeah.
It's actually understanding how can we safely start using it, considering everything else that we have around us built, without it falling down like a house of cards. And solving for that is the priority for everybody right now.
And if you were then going to make a prediction about this, I mean, in 2030, let's say, arbitrary time in the future, but what are we expecting to see as a marker of success? Like, what do we expect to be seeing as stablecoins made it in 2030, and the KPI that is household name, everyone knows this is a marker in the sand to prove that? What are we expecting to see in the future? Is it more linked on what the banks are doing with it? Is it more linked on the absolute issuance and market cap of things like USDC and USDT? Or what are some of the markers and headlines you'd expect to see, 5-6 years out?
Before I come to the headline, maybe a statement on the point you just made, right? US dollar denominated stable coins are going to dominate, and we are already seeing that 99% of them are US dollar backed. But there will also be other credible options like the EU or some other currency that will be around. And then there will be local jurisdictional stable coins actually taking care of specific trade settlements and local transactions. So that's going to be how the domination is probably going to be in 5 to 8 years. It may change over a period of time. The headline I can see is G20 nations agreeing on global stablecoin reserve standards. And the other headline I can think of is stablecoin earns a boring victory.
That's a good headline. We're going to probably see that in a few years. No, I would say, first of all, for this thing to work, we have to be in a place to stop talking about it. Like, we don't talk about how you wire money and it goes from bank A to bank B anymore. It's just do it, right? But this has been such a big discussion around, how is this done and which rails and which blockchain.
Yes.
And so, first of all, that needs to go away. There has to be the abstraction of that, and it has to infiltrate everywhere. But I think banks are still lost. I was talking to a Korean bank yesterday. It was telling me, we got it. We're going to now get into the space, but we're going to build everything on private chains. So still, we're still years away. And I would say, lastly, the headline I expect to see in 5-10 years plus is maybe something like the IMF includes US dollar stablecoins in the SDR composition. That will be taking it to the next level.
Powered by Moody's, of course. Hey, how about you, Chris?
Yeah, not much to add, I guess, on these points. I think like in 2030, I hope things just become increasingly more boring. I think ideally banks look at stablecoins like they do US dollars, and look at tokenized money market funds, like look at money market funds, and things just happen natively on chain. And I think that enables a whole suite of composable products and agentic payments. And like there are a lot of applications that can be built on top of this sort of like base functionality once we get to the point where this like stable coins and tokenized assets resemble traditional currencies and assets on balance sheets.
Yeah, and I couldn't agree more. And just to wrap up, I think we've managed to get through the first ever panel on stablecoins without talking about regulation. So we'll save that for people later in the day. But thank you very much, guys, for the insight here. And we're going to have to wrap up. But yeah, appreciate the input and great to discuss this with you all. Thank you.
Thank you.
Thank you.